Dow is good for 0.5%. That's basically where the S&P is. NASDAQ is trying to get something going. There's the yields on the 10-year note, 151. Steve Weiss, come to you first. You told us yesterday that you were short the S&P, that you were short the SMH, that you were cautious. So where are you today for an update from somebody who can trade in and out pretty quickly?
So I covered the S&P yesterday. I covered the SMH. That was a poor cover. But when it declined by what it did, I want to take the profits. So here's where we are. We had one pre-announcement today, the second one in a month from Sherwin-Williams. Yet the stock's up because people feel, okay, all the bad news is out. We'll see. We had Micron that missed. That stock's okay. It was highly negative there. I also covered Micron yesterday before the close, by the way. So
are you not as negative?
I'm reinforced in my position.
You're not as negative?
No, I am as negative.
Cut to the chase.
Let me finish. I'm reinforced in my cautiousness because we're seeing these pre-announcements. And I think the market, as the saying goes, is whistling by the graveyard here. I'm not looking for an economic collapse. That's not the story. The story is that the supply chain continues to hit companies in two ways. Revenues decline or earnings decline because of margin pressure. And I think that's going to be the constant theme of the market. So, yes, it's up today, not nearly recovering what we lost yesterday. I think there will be better buying opportunities as we get through the quarter and that you lose nothing by staying on the sidelines. As a matter of fact, when you generate return, it's a question of where you get in, where your cost of acquisition of that position is. And what I'm saying is that I'm emboldened by what I've heard overnight and that you'll get better opportunities because the quarter is going to be very punk.
So you think that when I asked the question at the top of the show, broken or buyable, for the moment, we're broken. We're not yet buyable.
I think that's correct. I'm not buying into it. Look, we could see the 10 years backed off today in terms of the yield. It's rallied a little bit. And that has to be expected after the big increase in rates that we've had. But I don't think we've seen the end of the 10-year yield going higher. I think we can see it at 160 in relatively short order. So, look, the NASDAQ is not acting great today. Given what we saw yesterday, NASDAQ is actually flat, so to speak. So I'm not blown away by this action. To me, it's an indication that retail is getting tired of buying the dips. Not as much money is coming in. So I've got a lot of red in my screen still. I'm happy to wait.
Yeah, so do a lot of other people.
It's not buyable yet.
I hear you. All right, Bryn, where do you come down? Tom Lee says we're bending, we're not breaking. One could look at this as a retest of the lows from last week. If this is the case, markets need to find footing soon, which is what we expect. Citi says the likelihood of a correction likely to be of the smaller variety, less than 10%. They say UBS, yields can rise further, but so can equities. What say you?
Well, I think I'm going to add a third one. We all own stocks, right? We saw fund flows this year have just been extraordinary as retail investors have come back into the market. I would be more in Tom Lee's camp about bendable. And I think what investors have to also understand is, technology is close to 30% of the S&P, like 26 to 28%. And so definitely the S&P generally will have headwinds as rates have risen. So you have to understand that. But what's not broken are things like energy, which is 2.5% of the S&P. And if it doubles again, it won't have any impact. And so I think that as we're going through this back and forth of when the Fed, is it a taper or is it just ending a program that needed to go away? And when that starts, when we start seeing natural price discovery return back into the Treasury market, I think that's when we'll really understand where the market trajectory will go longer term and whether tech will face more of a 1 quarter, 2 quarter headwind, or this is just going to be a blip. But I do think that the market's nervous about, the debt ceiling, which we hope it's politics, not politricks, and that gets involved. And then also yesterday, kind of the theatrics around Jay Powell and, Elizabeth Warren being theatrical about that, I think is also unsettling about whether he's renominated or not. Mm-hmm. So it's definitely bendable. I don't think it's going to break. We still have a ton of liquidity in the market. But you have to understand, tech is a huge part of the S&P, and the Qs haven't even hit their 100-day moving average, which is about, I think, 357. So you want to see it hit that and then hold.
Well, you sold calls in the Q, in the Qs.
Right, exactly. I mean, so I sold calls. The Qs are one of my biggest position, my biggest tech position for sure. And this is a great environment to be selling calls because if you think your security or this ETF is going to be flat to down over the short term, you can sell those calls and collect income. So I just want to like make my portfolio sweat for me as much as possible. And if I see an opportunity to sell those calls, I definitely don't want the Qs to get called away. And so I sold the December 390. Which it's so far away from that, I'm not even close to getting called away. And I captured about a 3%, 3% income over the next 3 months for holding that. So I think it's a good portfolio strategy to collect income. And it's always nice to see green in your account when you have some, red on the screen.